Your first investment portfolio. You've opened and funded your brokerage account. Now comes the question everyone eventually asks: what should I actually buy? The good news is that long-term investing does not require finding the next great company. Many successful investors build their portfolios using just a few broadly diversified, low-cost funds. Today, we'll see exactly what that can look like. A portfolio has 3 jobs. 1. Provide long-term growth. 2. Diversify across countries and sectors. 3. Reduce the impact of market downturns. These goals are achieved through asset allocation and diversification, while portfolio maintenance and rebalancing will be covered in detail in the next video. The US Equity Foundation. For many investors, the foundation is a broad US stock market index fund. One example is VTI, which tracks the entire US stock market and gives you ownership in thousands of companies with a single purchase, maintaining an ultra-low expense ratio of around 0.03%. The key idea is not the ticker symbol itself. The key is to look for a low-cost fund, ideally with an expense ratio below 0.10%, that tracks a broad market index like the CRSPUS Total Market Index. International diversification. A second building block is an international stock fund. One example is VXUS, which provides exposure to companies outside the United States with an expense ratio around 0.05%, tracking the FTSE Global All Cap Index. Science is global, and so is business. International diversification reduces your dependence on the fortunes of any single country by spreading your exposure across varying macroeconomic cycles and international markets. Stability. Through bonds. The final component is often a broad bond fund such as BND, which tracks the Bloomberg US Aggregate Float Adjusted Index with a low expense ratio around 0.03%. Bonds help moderate the ups and downs of a portfolio and become increasingly important as your investment horizon shortens. A simple example portfolio might therefore consist of 1. A US stock market fund such as VTI2, an international fund such as VXUS, and 3. A broad bond fund such as BND. The specific percentages you assign to each component depend on your individual goals, age, and tolerance for market fluctuations. This is an illustration, not a financial recommendation. We will explore how to determine these precise allocations in our next module. Also, and as we mentioned in a previous video, many investors keep the vast majority of their money in this diversified core and reserve a small portion, perhaps up to 10%, for individual companies or themes they wish to explore. Build the foundation first, explore second. Before investing, ask, is the fund broadly diversified? Does it have a low expense ratio, ideally under 0.10% for broad index funds? Which index does it track? These simple questions can help you avoid many common mistakes. Your task before the next video is to identify one broad US stock fund, one international stock fund, and one bond fund available through your brokerage or retirement plan. Read their descriptions and note the indexes they track. In the next video, we'll discuss how to decide on the exact percentages for each category and how to maintain your portfolio over time. Remember, understand the foundations. Build a simple structure. Let time do the heavy lifting. Thank you for watching, and I'll see you in the next video.